Welcome to the Bloomberg Markets Podcast. I'm Paul Sweeney, alongside my co-host, Matt Miller.
Every business day, we bring you interviews from CEOs, market pros, and Bloomberg experts, along with essential market-moving news.
Find the Bloomberg Markets Podcast on Apple Podcasts or wherever you listen to podcasts and at Bloomberg.com/podcast. Our next guest, I guess I got to call him like my favorite economist, but that's not saying a whole lot, quite frankly, but he is good, and we're glad we got a few minutes of his time. Carl Riccadonna, he's BNP Paribas now. I trained him up here at Bloomberg Intelligence for many years, but he's pretty solid. Carl, what are you looking at today? We just heard from the good folks, Dana Peterson at the leading economic indicator at the Conference Board. They still have a recession call out there. How about you guys at BNP Paribas?
Well, Paul, I should back that up. You taught me everything I know, of course. So, thanks for that. I'll start with that. But in terms of the recession view, we still see some pretty ominous factors looming on the horizon. You've been talking about the resumption of student debt payments. Right. Now we can, there may be some wiggle room here that you have a 12-month grace period. To start and whatnot. But if we just look at the view from 60,000 feet, the price tag on that is about $100 billion annualized. So look back to Q1 when everything went haywire with the cost of living adjustment and Social Security. That was also about $100 billion price tag. So I'm sure they're not equal. But when you look from when you squint from a distance, they're of similar sizes. And so all of the things that went up in Q1, discretionary spending and whatnot, we could see kind of a similar fallout in the Q4 period. But on top of that, you have a very divided government that has to pass 12 appropriation bills by the end of this month, or by the end of September, rather. That seems very unlikely. So there's a risk of a government shutdown then. The excess savings story, we've been focusing on this. San Francisco Fed wrote on this recently. Those savings are rapidly being eroded. You see that in the retail earnings you discussed in the earlier segment, where Target is noticing the price sensitivity of consumers, and Walmart sees a lot of the higher end consumers walking into Walmart to go after those bargain prices and whatnot. So you kind of see that playing out, so there's a bit of a perfect storm, I think, coming about in Q4, which still makes me worried about elevated recession risk in Q4 and into the kind of first part of next year.
How do you square that away when a lot of this data still is pretty resilient? If you're looking at retail sales, even the Atlanta Fed's GDP now for the current quarter up around 5%. Yeah. And when you're talking about Walmart coming in and better than expected outlook on the consumer, as far as you talked about student loans, I mean, what's the main catalyst here to really weigh on consumers when we're looking at the difference between spending when you're talking about obviously goods versus services?
Well, I think the GDP tracker in the at the early part of the quarter can often go for a real loop. And I think that's what we're seeing at the moment. I highly doubt we're growing at 5% in the current quarter in inflation-adjusted terms. So I value the Atlanta Fed GDP Now tracker.
It can be volatile.
Follow it, but it does move. It does move over the course of the quarter. That's not unusual, and so I do think we'll see some moderation in that indicator over the course of the quarter. That being said, there is a theme of resilience here, whether it's the labor market or consumer activity and whatnot. But you always have to be looking forward, and you're hearing those anecdotes of price sensitivity from consumers. So the real test will be, if this can hold out over the course of the quarter, or if July just happened to be a good month for retail, whether weather was driving people into shopping malls or Amazon Prime Day, or a lot of these factors, maybe just one-off developments. When we kind of step back and look at the macro fundamentals, the broader GDP trend, so not the quarter-on-quarter change that we see in the GDP Now forecast, but rather the year-on-year rate of change is slowing. What does disturb me is GDI, so gross domestic income, which in a perfect world should track in lockstep with GDP. But the guy who taught me everything I know, Paul Sweeney, don't live in a perfect world. And the GDI numbers look pretty bad. So gross domestic income, well, first of all, profits are slowing and gross domestic income looks pretty lousy. We'll see the next print on that when we get the second print for Q2 GDP. but GDI is a pretty disturbing trend. So there's definitely fodder for both sides of the debate here, and I'm not convinced of the reacceleration narrative just yet.
We've certainly seen, Carl, over the last, couple of weeks, some really disappointing economic news come out of China. How do you kind of think about that as you think about the impact of the U.S. economy?
Well, China's obviously a very important trading partner, and global commodity prices are very sensitive to the health of the Chinese economy. And those commodity prices impact the U.S. inflation outlook. So, we're definitely watching the situation very closely and trying to understand what's happening, in the kind of immediate reopening after COVID, and then, where things settle there. There seem to be some key differences. So, in Europe and the U.S., we saw a lot of pent-up savings and pent-up demand that really led to the, kind of revenge spending and house price appreciation and demand for, for a lot of consumer spending categories. It looks very different in China, and we're seeing that play out. That the reopening of the second largest economy in the world looks very different than what we've seen in the U.S. and Europe. And we're seeing that pass through to supply chains, and this is feeding into an inflation narrative of deceleration. But our view has been at BNP for quite a while that the last mile is going to be where the real toughness comes out and the real stickiness of the inflation data is apparent, and that's going to mean that this Fed can't. We'll have a course correction on the immaculate disinflation narrative, and the Fed is going to have to remain vigilant in its inflation fight to get us all the way back to 2%. It's easy to get from 9% down to 6%,
right.
But getting from 6 to 4 is harder, and getting from 4 to 2 is where it will really take some softening of labor conditions and some of the categories that have been sticky to really move lower.
All right, you brought up the Fed. We do have Jackson Hole next week. How do you view this and what this could potentially mean for their signaling ahead of that September 20th decision?
I don't think they're going to signal much for the September decision. Of course, they'll be asked in the press conferences and media exchanges and whatnot what they're thinking, and I think they'll give us the generic Fed answers of, well, there's more data to be seen, so we don't want to cast a judgment.
Well, we did get the employment cost index, CPI, PPI, and then PCE since the last decision, so it feels like those Fed minutes we got yesterday might be a bit backward looking, right?
That is spot on analysis, because people are focusing on some of the hawkish language that was in the minutes where they said there's still upside risk to inflation and therefore we may need to do more. We have to remember they wrote those words, and then we got a cooler CPI report, a cooler ECI report, a still hot but cooling trend in the labor data, right? So that dates some of that language. And I think the more important takeaway from the minutes was that they're looking at this in a very two-sided fashion now as they assess risks for the outlook, doing too much but also doing too little, whereas before they were always kind of worried they were behind the curve and were just focused on catching up. So this is a different, more thoughtful, more data-sensitive Fed going forward. I think this may mean that they're on hold, and in fact they may have been at the peak rate of the cycle at the July meeting, and they're done now, even though they don't want to say mission accomplished.
Right. All right, Carl, thanks so much for joining us. Always appreciate getting your perspective, your analysis. Carl Riccadonna, one of the best. He's a chief U.S. economist at BNP Paribas.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business app, or listen on demand wherever you get your podcasts.
Here at Bloomberg, we love talking about central bank activity.
Yes.
We're all over that stuff. Today, we're going to focus a little bit on the Bank of Japan, and we have a great guest to help us do that. Regina Schleiger, Director of Central Bank Policy Research at SGH Macro Advisors. She joins us live here in our Bloomberg Interactive Broker Studio. I have to admit, Regina, of all the central banks, I'm probably least comfortable or knowledgeable about what they are doing. So just give us a sense of what the BOJ's been up to really over the last several years and kind of what you expect them to do going forward.
Sure. Thanks, Paul. Thanks for having me, and nice to see you both this morning. So the Bank of Japan has been somewhat of a laggard in terms of central bank policy tightening over recent couple of years. And so markets are quite focused on the timing of their transition to tighten policy, particularly with respect to transitioning out of what they have had in place now for many years, yield curve targeting, which is them targeting the 10-year yield. And so they have recently shifted toward more flexible arrangement or regime with respect to yield curve targeting, which markets are obviously taking as a signal that they are on the move, if you like, and soon to be thinking about higher interest rates at some point. Markets intensely focused on the timing of that and taking every signal they can from the economy to try to gauge when they're likely to move.
And very different, like you were saying, if you juxtapose that against the Federal Reserve and other global central banks that clearly have been on this aggressive tightening cycle for over a year now. How do you think that impacts the global economy? Because Japan is the third largest economy behind the United States and China.
Absolutely, and as you rightly infer, there's a huge yield differential now between the US and Japan, and so one of the things that we've become aware of is that officials in Japan are, waiting for the Fed to be done, if you like, with respect to their tightening cycle, so that they can start to think about how they will move on their own rates and narrow that differential. They have a currency right now which is at levels that they're not entirely comfortable with.
Right, so the yen breaching 145.
Right. So this is a policy driver for them in the sense that they have now, I think, admitted that it's a big factor in how they're thinking about how to transition smoothly out of this ultra easy policy that they've had now for a very long time, and I think that really that rate differential is not going to narrow until they actually move to move on rates.
Right. So the yen breaching, it's now around 146 against the dollar. How much does that stoke expectations that it could prompt the Bank of Japan to have more intervention from here?
Right, so that right now there is a lot of speculation that they could come in. In fact, overnight I was even reading about expectations that they could come while Japan is asleep, essentially, and do some stealth intervention. There is a lot of focus on when and how they'll intervene and at what level. I think from a broader perspective that whenever that intervention is and at what level, it's not necessarily as important as what they do on the monetary policy side. And so the impact on the market, I think, of any intervention, Ministry of Finance officials, execute is not. It has a more transient effect, I think, on markets than does the speculation about what they'll do with interest rates and when.
We've had a change in leadership of the Bank of Japan. Just talk to us about that, what that means and going forward. Yeah,
I think this is a really interesting element. I mean, we're always at pains to try and discern these differences in personality when there's a change in leadership at a central bank. In particular, I think that the exit of the former Central Bank of Japan governor, Kuroda, ushered in this succession of a new governor who comes from a school of thought or an academic background where he relies more heavily on forward guidance. Mm-hmm. That's more the Bernanke, Draghi school of thought. And so I think that one of the elements that's really obvious to me through this transition of the leadership is the extent to which he has been starting to impart that forward guidance. I think that he's going to rely quite heavily on signalling. Rhetorically, the bank has held quite firm to this ultra easy policy, but you can detect little nuances in the way he's shifting the language so that markets are understanding that the bank is on the move.
And also we'll have another update when it comes to consumer prices. And if you looked at the latest data from the prior month, it did advance at a faster clip. How do you view the direction of where those prices could be headed from here?
Right. So this is another really interesting element because the headline rate is expected to show that prices fell. in this report. That would be consistent with the BOJ's own forecasts. They expect in fiscal year that inflation will have risen, but in the next fiscal year they anticipate that inflation will slow to under the 2% objective.
So they have the same what is this 2% number? Everybody's got a 2% inflation.
The magic 2% number.
I never
It
heard
started from New Zealand in the 1980s. And then Bernanke, I think, was
all right,
the
so
one that
Japan's
made
on the
it
2% inflation watch as well.
They're on the watch, yes.
All right, so I'm looking at the eco function on the Bloomberg terminal and putting it in there for Japan. I guess the forecast is for CPI, I guess the headline year over year, 3.3%.
Right.
So getting there but not there.
Getting there but not there. And also,
first time, by the way, I've ever pulled up Japan screen on my eco thing. Okay.
And also on an underlying basis, I think that's the important number. You know, with X energy, they're very focused on what the core rate is doing.
Okay.
I have to get your thoughts on when it comes to this discussion. JP Morgan actually had a recent note about China's Japanification risk. So seeing similar concerns that Japan did in the early 1990s kind of set the scene for us about how that worked and what that could mean potentially for China.
Well, obviously there is so much concern about China at the moment. It's seeping into market psychology, I think, with respect to how it potentially impacts US Federal Reserve's future outlook and other economies. It's impacting the extent to which we think that central banks might be done in their own respective tightening campaigns. But in terms of in terms of China becoming Japan, I think we're some way off assessing that is the decidedly the outlook for China. Having said that, there are real concerns there, and I think that China experts more adept than I have voiced them for many years.
When I started in the business back in the mid 80s, Japan was the bomb.
Yeah.
If you were a U.S. investment banker, you had to get a tour of duty in Tokyo. But that's not the case for a long time. Give us just the overview. How do you think, or how do economists think the Japan economy will be over the next 5 or 10 years or something?
Yeah, it's an interesting point. I like you, Paul, was in Japan around that time, and it was a global superpower, no doubt. And since it's been in the doldrums, obviously. I think that as they emerge from what has been 25-year slump, the economy is probably not likely to see those heady days again to the extent that they did in the 80s and early 90s. That said, I think the Japanese officials have very long memories, and they'll be very, very cautious and careful about moving too quickly to curb any kind of ebullience in the economy, for fear that they might be reverting back to inflation that's under 2%.
I mean, again, as a U.S. investment banker, there was Asia, then there was non-Japan Asia. So basically, it was Japan and everything else.
Right.
Now it's China and everything else. So it's just how times have changed. Regina Schleiger, thanks so much for joining us, giving us a view of that part of the world.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg Radio, the TuneIn app, Bloomberg.com, and the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
So we've got one of the leading reinsurance companies here in our Bloomberg Interactive Broker Studio, Juan Andrade, CEO of Everest. They're based, where else? Bermuda. Scam. But that's how these guys do it. Juan, he's here in our Bloomberg Interactive Broker Studio. Juan, thanks for coming in. Appreciate it.
Thanks, Paul.
Talk to us about the reinsurance business. What's driving your business these days? I'm looking at your stock. It's a $15 billion market cap company. You've got Juan, EG is a ticker, up about 7% year to date, 30% over the last 12 months. What are the key drivers of your business?
Yeah, no, it's a fascinating question. I mean, if you think about the confluence of events that we've all lived through over the last few years, whether it's the pandemic, the supply chain issues, inflation, climate change, all of that is driving demand. And again, as you said, we basically insure insurance companies. So when you think about what's driving our business right now, it's the fact that these insurance companies are looking for protection for earnings volatility, essentially. And so that increases the demand for our product.
And there's been a price correction in the insurance industry. Why?
There's been a significant price correction. You're absolutely right. And it's really down to a supply and demand imbalance. The bottom line is, with all the storms and all the activity that we've seen since 2017, reinsurance companies have deployed less capital into the market, so that's constrained supply. The other thing that's happened on the supply side is a lot of third-party allocators, pension funds, sovereign wealth funds that used to put money into our sector have also pulled out. And so that's created a supply crunch, if you will, in the industry. But at the same time, because of inflation, climate change, all of these other things, there's more demand. So there's basically a gap of roughly $100 billion between supply and demand. And that's what's created the price correction that really started at the beginning of this year in a pretty significant way.
Hey, Juan, when you bump into a climate change denier, what do you say to that person? I always say, like, somebody, when I bump into them, I say, go talk to an insurance company. They'll tell you if it's real or not. What do you say?
Well, I think that's good advice, by the way, because that is what we do on a day in and day out basis. Just look at what happened in Maui.
Okay.
And I think that's a perfect example of that, right? You know, the island had significantly high temperatures because of what's been happening around the world. Drought, which basically dried all the grasses. And then you have a hurricane that's churning off the coast, putting out 60, 70 mile an hour winds. So once you get the spark that started this and you got those winds, you get, unfortunately, the tragedy that unfolded in Maui. And look, all of this is scientifically proven, right? Wildfires, floods, droughts, all of that is directly related to what we're seeing. You know, one of the interesting statistics that's out there right now, the ocean, whether it's the Pacific or the Atlantic Ocean right now, is at the warmest temperature it's been since recorded history. That tells you something. Now, the end game of that is that you're going to get more severe storms because they fuel off of the higher temperatures in the ocean. So what I would just say is look at the facts.
So are the insurance companies that you insure, how's that reflected in their business? I've heard like a lot of insurance companies won't even do business in Florida anymore. So how do you see that in your business? And I mean, are you charging more for that? Increased risk? How does that affect your business?
It affects us in a number of different ways. So yes, one is we're charging more. That's part of that price correction that we talked about. The second thing is we try to embed the latest science into our models to be able to do better predictions on where storms are going to develop, where they're going to hit, the coastlines, et cetera, et cetera. But the other thing that you're seeing right now, and you've seen the headlines from companies moving out of Florida or moving out of California, there's also public policy issues that we have to address. I think the governor of Florida and the legislature did a nice job with tort reform in Florida, because one of their significant issues was not only climate change and the storms that come out of that, but it's also fraud and abuse in the system. And so the governor took strong actions on that. California, it's a different story. At this point in time, you know, you have a lot of companies leaving the state because the market is not functioning as well as it should be. And at the end of the day, we all have shareholders or stakeholders, and we're for-profit business.
The Hawaii wildfires, insured losses are estimated to be around $3 billion, but at the same time, Hawaii is one of the nation's lowest rates when it comes to homeowner coverage, just because it really hasn't had a ton of natural disasters. How does that affect insurers? Yeah,
it's a great point, because that also goes back to Paul's question on climate change. Hawaii itself is not known as sort of a natural catastrophe hotspot, you know, similar to when you think about Florida or when you think about California. What will happen as a result of this is prices will go up again, right? A lot of claims will be paid. I think, as you said, it's about $3 to $3.2 billion in industry loss that is expected to come out of that fire. So insurance companies will basically adjust their pricing because the risk is there, essentially.
You guys are a global company. Talk to us about how business is different U.S. versus outside of the U.S.
Yeah, no, look, I've spent a vast majority of my career actually working outside of the United States. And we are global, so we are the fourth largest property casualty reinsurer in the world. We have customers in 115 countries. And, you know, our business is really a relationship business, and you really have to adapt to how you do business in different cultures, right? Whether it's an Asian culture, a Latin American culture, where, you know, before you do a deal, they have to understand who you are, they need to trust you, et cetera. Whether it's in Europe and the US, you might be more direct, get to the bottom line a little bit quicker, et cetera. But the issues are fundamentally the same. At the end of the day, we're insuring risk, so we have to understand what we're taking on our balance sheet, what we price for it, and you also need to understand the geography, the climate, the geopolitical issues, regulatory environments, all that sort of thing.
We have about a minute left. What's your thought on what the reinsurance industry is telling us on where the economy is headed?
Yeah, look, I think if you look at our industry, we're sort of a bright light in what's happening in capital markets right now. And I'll give you our own example. So we just posted in the second quarter a 25% annualized total shareholder return and a 22% plus ROE. And so that tells you sort of what we're seeing in the opportunities that are out there because of the uncertainty in the world right now, heightened risk environment, geopolitical issues, climate change issues, et cetera. So we're pretty bullish about where the industry's going, not only this year, but well into 2024 as well.
All right, Juan, thanks so much for joining us. Really appreciate you taking the time to come into our Bloomberg Interactive Broker studio. Juan Andrade, he's the CEO of Everest, the ticker's EG. Everest Group, a New York Stock Exchange traded company. You guys have an investor day coming up in November at the NYSE, so that'll be big for you guys. Maybe we'll get you back in the studio since you're going to be back in New York. That'll be good stuff.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business app, or listen on demand wherever you get your podcasts.
All right, let's talk about commercial real estate. This is near and dear to my heart because I walk through Midtown Manhattan every day back and forth to Penn Station, and I'm firsthand. I can check out what's happening. Our next guest knows about what's happening too. Hessam Nadji, he's the CEO of Marcus Millichap, which is a New York Stock Exchange traded company. MMI is the ticker. He joins us live here in our Bloomberg Interactive Broker studio. Hessam, thank you very much for joining us. All right, I walk back and forth twice a day, Midtown Manhattan. I look up and there's a lot of empty space here. This is a disaster in certain big cities. We'll get to some of the good parts of commercial real estate, but what happens to the New Yorks, the San Franciscos? In reality, they're not converting all this stuff to condos. What do you think? How is this going to shake out?
Good morning. Thanks for having me on. Great to see you again. It is going to be painful in the next 2 to 4 years. There's no way around it. But the bifurcation of what's happening with newer, high amenity office space versus older, obsolete office space is the story. In that overall demand has shrunk. The pandemic has changed societal patterns that are not going to come back anytime soon. We're seeing improvement, by the way. We're up to about 48, 50% daily attendance, not vacancy rates, but utilization rates of people in office spaces, which is amazing to even share with you, in that we're at 48 or 50%, up from 10 or 20% right after the pandemic. It is a profound reduction of office space demand, which means quality buildings can be more popular, and older properties are going to see the vacancies go up significantly.
And we all know how bullish Paul Sweeney is about in-office when it comes to our employees here at Bloomberg. What do you think is the key catalyst that could fix this situation?
Time. When people realize that working in isolation 100% of the time, for those that have been virtual 100% of the time, really affects your career, affects your collaboration, affects your skill sets. That takes time to play out. But we're seeing more and more people want to come back, just not 5 days a week full time. So amenities, ease of getting to work, different ways to attract workers to want to be back together are the key strategies we're hearing from our office clients all over the country, and they're actively pursuing creative ways to do that.
What about also so much discussion, obviously, about a recession, but whether or not at a certain point the economy would slow down in the next few years, when that could potentially happen, we don't know. But how much is that the catalyst? Because then you have more power when it comes to the employer, and if you are the employee and you're looking for a job, does that switch the dynamic?
Absolutely, because we've had no leverage as employers to mandate anything. You have to adapt to what the workforce wants in a 3.7% unemployment environment. If that shifts, of course, the dynamics will shift as well. But the one thing I really want to highlight is that there's so much coverage of distressed office space, putting more stress on the banking system, and a lot of headlines around that. And I wanted to really share with you and your audience that 24% of total bank outstanding loans are in commercial real estate, and 15% of that is in office. And a very large portion of that office loan portfolio is performing just fine. So do we have stress in the system? Absolutely. Is it going to get worse as leases roll over for office? Absolutely. But is it a threat to the entire banking system? The answer is no.
How about, if I want to go build a building somewhere in one of the growth markets, my cost of capital is much higher. Can I even get a loan for commercial real estate these days if I want to go build an office building?
The answer is yes, but you're going to pay a very high price for that debt. It's going to be underwritten so carefully. And as a sponsor, a developer, you have to have an amazing track record and an equity partner. It's happening very rarely right now. Part of what happens in a cycle like this is you get a big pullback in new supply. And thankfully, office hasn't had much new supply in the last 10 years.
Right.
Otherwise, this problem would be much bigger. But the construction loans are very difficult to get. Land is expensive.
Yep.
And materials and labor is also another reason, another deterrent to new supply. The other thing to share is the other segments of commercial real estate outside of office, apartments, even shopping centers, self-storage units, hotels. They're performing extremely well because they are aligned with a strong economy. We've had great job growth, very low unemployment. That is reflected in demand for all kinds of commercial real estate space outside of office.
And how does that compare when you're talking about the portion of loan portfolios? If you are looking at, say, retail apartments versus office, can that offset what we see with the issues when it comes to the office space?
You know, I really believe that the heavily tilted loan portfolios toward multifamily apartments, they have occupancy of around 95%.
Yeah.
And even though rent growth has really slowed after 3 years of very robust above average rent growth, apartments are doing great, and those loans are performing just fine. We have a disconnect on the valuation of apartments, therefore sales activity, trading activity is way down because interest rates shot up in the lowest cap rate, lowest yield product type in the industry. So there's a big disconnect between buyers and sellers. The trading is way down, but the loan performance is just fine because the occupancies are high, and apartments make up the bulk of outstanding loans.
So if I'm a building owner and I got to refinance my debt. Wow, that's a tough nut. I mean, what's happening in that market?
If your property is in distress, chances are the lender will work with you because the Fed and the Treasury have gone to the banks and said, work with your distressed borrowers. That's been the message to avoid a fire sale. Nonetheless, you're seeing some distressed sales come out of loan portfolios. There's no question about it. If you're performing well, if your asset is performing well and occupancies are good, rent collections are good, there is financing available, but it means you have to come up with more equity. If you're upside down in the valuation and the loan to value ratios, depending on when you finance the deal. Now remember, most commercial real estate loans are 5 to 7 years in term. So 5 to 7 years ago, prices were a lot lower and occupancies and rents were a lot lower. So should be plenty of margin, even with the
who provides the equity? Who would I go to for equity? Is there private equity out there for just real estate? And I guess the question is, are they willing? I know some of these people now that I think about it, and they do quite well. Will they make that equity investment today?
Yeah, absolutely. There's plenty of capital. And one thing we're not seeing a shortage of is capital ready to pounce. And when we see prices that have adjusted from the peak to the tune of 10 to 25%, there's multiple offers on properties, even with the credit crunch that we're facing.
One of the questions, I want to see it, like in New York and in San Francisco, is I haven't seen anything trade. I think if you see a marquee building trade in Manhattan, is it going to be down 10%, 30%, 50%? I think those are the numbers we're going to be seeing, and we haven't seen that.
Right.
That's going to shock the market, won't it?
If it's an older office building, it's closer to the 50% you're talking about. If it's a newer asset with good amenities and great occupancies, it's going to be closer to the 10% you're talking about.
Wow.
What's the top question you hear from your shareholders?
How long will it take for this market correction to reverse, and what's the outlook for trading activity? Because our business as a leading broker of investment properties and financing of commercial real estate in the country, North America, I should say, including Canada, is all dependent on trading activity. And trading activity is down somewhere between 50 to 60% market-wide because of the buyer-seller price disconnect and a very tough financing environment. Yep. And we think that once the Fed is done, which may be a little bit down the road, we were hoping that by now the Fed would really declare mission accomplished on inflation. I think we still have a little ways to go, but not far, because inflation numbers still don't reflect the drop in housing, the equivalent of housing costs, because they lag by about a year. So when the current leases roll over and the index for inflation shows the drop in housing costs, I think inflation is going to go down quicker. So I think we're very close to that end, and the ending of the tightening cycle itself will bring a lot of stability for both lenders on setting price and buyers, which are going to be borrowers essentially. and then put a little time on top of that with prices adjusting. Sellers are usually behind the market by a year and being realistic about what price an asset will trade at, because they're hoping for last year's pricing when the market has corrected. Both of those are starting to come together, but we're not quite there yet.
All right, Hessam Nadji, thanks so much for joining us. Really appreciate it. Hessam Nadji, he is the president and CEO of Marcus and Millichap, New York Stock Exchange traded company. MMI is the ticker. About 1.3 billion of market cap out there. So looking at the national brokerage commercial real estate, interesting time for that market, particularly in some of the larger markets. Again, I want to see some marquee properties trade in New York and see where that goes. I just saw Billy Rudin on the Death Star earlier this morning talking about the commercial real estate market. That family is long NYC real estate. So see how some of that plays out.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg Radio, the TuneIn app, Bloomberg.com, and the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Right now we're talking about Walmart, and that is also another great read on the consumer. Their numbers, I thought, came in pretty well. Stock's kind of trading sideways.
Raised its annual profit
Yeah,
forecast.
I mean, people are shopping at Walmart, and you can't. I mean, talk about a staple. I mean, they're just you can't avoid Walmart at all. Jen Bartashus, she covers Walmart. She's a senior industry analyst at Bloomberg Intelligence. Jen, what was a key takeaway from the results from our good friends from Bentonville?
Well, it really, when we look at Walmart, obviously they're on a roll, and they're continuing to draw consumers in. The messaging that we heard is that consumers continue to be a little bit conservative, but they're being selective about where they're shopping. And so they're saving on essentials, they're splurging a little bit in other areas, but Walmart has really positioned itself well to serve any customer that's coming through its stores with how they're offering value to those people.
All right, Jen, you taught me, or you let me know a couple of years ago, that the number one grocery chain in the U.S. is Walmart. I was shocked to learn that. Didn't even think about it. So if I go in to do my weekly shopping, do I then move over to the aisle and go buy some clothes and stuff like that? Does that really happen?
It actually really does, because part of what they're doing is they bring you into the store with compelling prices. People are going in to shop for groceries, and then on their way to the checkout, they see a T-shirt that's maybe $5, and they think, oh, well, there's some value, and it gets added into their cart. Or as they're looking to prepare meals, they're adding small kitchen appliances to help with the preparation of those meals. And so that cross-shopping into general merchandise is happening. And one of the things that Walmart called out is that even though general merchandise sales are still lower than last year, they're sequentially improved meaningfully from first quarter. And so that increase in momentum is actually really important as we get into back to school, when people will be looking for clothing and backpacks and shoes and things like that for their kids. So all signs point to a pretty good back to school season for Walmart.
Walmart is in the staples sector in the S&P 500 because that huge percentage of grocery sales, but so is Target. Okay. Target had been in the discretionary sector. Earlier in the spring, it did get moved into staples because of its percentage with groceries, but Target has a bit of a different story. It still cut its forecast, even though we saw improvements when it came to the inventories. What is it about Walmart? What is it doing differently that some of its counterparts aren't doing?
Well, I think the first thing is to just acknowledge the fact that Walmart's grocery offering is comprehensive. You can buy everything you need for a grocery shop at Walmart. That's a little bit different than at Target. Target's food strategy has been a little bit more targeted, in that they were looking specifically for products that may have some sort of unique appeal or attribute. So Target never wanted to position itself as a place where you would go and do all of your grocery shopping. It was more of a place of, look at these interesting things for discovery that are in the food area, some essentials that you need. But that difference in strategy is really showing now with the current economic backdrop and the way Walmart is acquiring more and more of the food shopping that's out there.
Hey, Jen, what is Walmart Plus, and how do Walmart Plus members, how do they shop?
So Walmart Plus is Walmart's subscription service, and it's similar to Amazon Prime for people who know that. And Walmart Plus is $98 a year. It offers you free shipping without any order minimum for things shipped to your house, but it also gives you free same-day delivery to your home from Walmart stores. And because Walmart is so big in the grocery business, membership has really been growing. It's been increasing. And in fact, we actually think that is a much underappreciated aspect of Walmart's business that's going to really drive sales and profit growth over the next 5 years.
We still have a lot of economists that are warning about the trajectory of the economy.
Oh,
when you
please,
look
stop
at
worrying.
Walmart's results, though, it's saying very much of a different story. What's your view of where the economy is headed when you have the world's biggest retailers signaling still some strength there?
Well, when we're looking at the economy in general, consumers are still under pressure. I think the advantage that Walmart has is that we are in a spot where we're seeing, for example, inflation on food come down. It's still high compared to 2 years ago, but it is starting to come down. And as inflation comes down, Walmart is able to very quickly work with their suppliers, lower their prices, and pass that on to customers. And so that is the backdrop is still quite conservative, and there are still a lot of consumers out there who have a lot of have to be careful with their budgets or being very selective on where they're spending. But Walmart's size and scale does position it well to take advantage of tempting them with even better deals as inflation starts to come down and people feel like they can spend a little bit more.
Jen, does Walmart open new superstores in America anymore? Are they pretty much everywhere where they want to be?
It's pretty rare. They have slowed their new store growth where they're only a handful a year. Sometimes they're replacing old stores or relocating them, and then there are very targeted new openings that are happening. But the majority of their new store growth is happening in the international markets. For example, in Mexico, they're adding many new stores every year because they're still in a growth phase. They're adding new stores in China and in other international markets, and so. There is still CapEx for new store development, but it tends to be outside the United States.
When it comes to back-to-school shopping, which is the key driver in the current quarter, how do you view that as far as what that could mean for Walmart and other retailers?
Well, in terms of back to school, Walmart actually said that so far they're off to a good start, which is a little bit different than the sound we heard from Target, which was much more cautious, saying there were only a couple of days into the season and that they didn't have a good read on it yet. For Walmart, one of their strategies they've done in the past year as inflation has been really high is they've targeted bundles of things and kept them at prices that were the same as last year. They did that at Thanksgiving for the Thanksgiving dinner. They're doing that for back to school. So they have a basket of 13 or 14 most common school items, whether it's crayons or colored pencils, and offering them at the same price as last year as a bundle. And that can be very appealing to consumers. So they've very clearly been thoughtful in their approach on how they're going to handle back to school and make sure that they are attracting customers to what they have to offer.
I know we might be a little bit ahead of this, but any sort of early indications about the holiday shopping season?
Well, historically, the rule of thumb in retail is that if back to school is strong, holiday tends to be strong as well. Back to school is a very reliable precursor to how the holiday season is going. So by the time we get through this current quarter and we have an idea of the third quarter results, we will have a very good read into how we think the holiday season will play out.
Walmart stock at a all-time high here today. And they went public back in 1970. Stock at an all-time high. Stevens & Company took them public, and Stevens & Company, good little investment bank in Little Rock, really good. They're still in business. Jen, is there what's the risk to Walmart? What's the risk to owning Walmart? Worst case, it's a GDP growth story.
Well, I mean, I think the risk is, potentially, the current management team has done a great job in shifting the entire culture of the company. But there are, we saw earlier this week some announcements of some management changes, especially at the heads of the different businesses. Doug McMillon appears to be ready to stay for a couple more years, but when that changes, there's always the risk that the company culture that he's worked so hard to instill will change. So that there is a risk. And then just because you're the biggest person in the room, there are always people coming, who have you in their sights. And so complacency, is the other real risk for Walmart.
Well, I mean,
and
the
that
reality
they just
is
need to make sure that they're continuing to execute on all these different things.
Yeah, I'm not buying
doing.
any of that. I mean, Amazon came in, and here's Walmart still hitting all-time highs. I mean, if they've shown they can compete against Amazon and that amazing business model.
So true.
I mean, you got to take your hat off. And that's why if you look at Rich Go, there are Waltons all over the Rich Go, which is the world's richest people. So they're doing something right. As is Jen Bartashus. Jen Bartashus, Senior Industry Analyst at Bloomberg Intelligence, one of our absolute best analysts. And we appreciate getting a few minutes of her time.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg Radio, the TuneIn app, Bloomberg.com, and the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Again, probably one of the bigger news coming out, over the last several weeks. It's just been this seemingly kind of never-ending or continuous flow of negative economic data coming out of China. Obviously not good for them, because remember we started the year and this was going to be a good year for China. Reopening was kind of the theme, and how do you play that, and what would it? And we're just not seeing it.
Yeah, then there was the downgrade in terms of the expectations for GDP growth, and then, oh wait, the property crisis is still escalating, or it's still very much alive, and then all this tension, geopolitical tensions.
Yep.
But we're going to sort this out, right?
Yeah, we're going to work this out right now with Jennifer Welch. She's a chief geoeconomist for Bloomberg Economics. She joins us from Washington, D.C. First, Jennifer, thanks for joining us. Please tell me what a geoeconomist is. That's a new term for me.
Thanks so much for having me. It's a term we're still defining, but essentially we look at the intersection of geopolitics and economics. So, for example, geopolitical developments with economic impacts and the use of economic tools to achieve geopolitical ends.
Dave Dwyer thought of that. It seems a little above his pay grade. All right, Jennifer, so what do we think about China here? The economic data, I don't know, it just doesn't seem very good, and I guess it seems disappointing relative to maybe expectations.
Yeah, no, I think that's a really great point. I would say from a geopolitical perspective, and this is a piece we put out recently, I think we shouldn't over-exaggerate the impact that this will have on China's geopolitical importance or exaggerate the effect that this will have on their foreign policy. There's a history here of rising powers lashing out when they feel they've hit their economic peak or when they're feeling sensitive about economic challenges, and we don't necessarily see that happening with Beijing. I think at the same time, we should expect that they'll be more defensive when they do feel challenged. But again, we're not looking at a major foreign policy crisis on the horizon as a result of the latest economic data.
We had an interview with the front runner in the presidential race in Taiwan, who is, I guess, seen as a little bit less favorable of a candidate with respect to China. I mean, can you weigh in on how China's economic woes are influencing that situation, especially because it's so close, because the tensions with Taiwan just being so physically close to China?
Yeah, sure thing. So I think you're referencing the recent interview with Taiwan's vice president and leading presidential candidate Lai Ching-te, who is actually just wrapping up a transit back through the United States on his way back to Taiwan. Lai is definitely not Beijing's preferred candidate. They've made that quite clear, including in their pretty strongly worded responses to his recent transit. This is despite the fact that it's pretty common for Taiwanese vice presidents and presidential candidates to come through the United States. In this case, Lai was on his way to Paraguay for the presidential inauguration there. Lai is ahead in the polls. It's early days still, but he does look to have a pretty strong lead for the elections in January. And I think there's a real question of how China would react to a Lai victory should he emerge at the top when the election's held in January.
Hey, Jennifer, can you give us a sense of how this administration kind of views or would like to see the relationship with China go over the next several years here? Is it one of engagement? Is it one of limited engagement? Is it one of just shunning China and letting them kind of deal with themselves? What's the approach?
Sure. So I think that the term is strategic rivalry, and the common catchphrase is, intense competition requires intense engagement. So we're likely to see both of these things. And frankly, I think the paradigms of the past of it's either engagement or it's hawkishness don't really apply anymore. I think the administration is trying to balance both of these features, both trying to engage Beijing, as we saw from Secretary Blinken's visit, Secretary Yellen's visit, discussion of Secretary Raimondo heading out this month, with continuing to take actions from the administration's perspective that are aimed at, defending U.S. interests, for example, rolling out the most recent outbound investment screening regime.
I mean, when you think of the struggles that China's economy is having right now, how does that change the dialogue in the Biden administration, in the White House, about how tough to be with respect to some of their geopolitical issues?
I think from a political perspective, this is a pretty good look for the administration. For the first time in many, many years, the U.S. GDP growth seems to be outpacing China's, and that's a pretty exciting story. I think from a foreign policy perspective, I don't see this changing in a major way, the administration's approach. Again, I think that's based on fundamentals that are unchanged here. China is going to continue to be a major power to be reckoned with. For example, they still have plenty of resources to put towards their military modernization, their technological advancement, et cetera. So I think the broad arc of the strategy is going to stay the same, but I would imagine there'll probably be some celebration about the recent economic data and how that shows how the administration's handling the U.S. economy.
It's interesting, Jennifer, I kind of feel a little bit of a dichotomy here, trying to take a tough government stance against China. There was some executive order last week to that end on the technology side. Yet it just seems like a parade of U.S. CEOs making their way over to Beijing, whether it's Elon Musk or Tim Welch or Jamie Dimon. I guess it's a kind of a fine line everybody's trying to walk here. We want to be tough against China, but we got to do business with these folks.
I think that's absolutely right, and I think that's contributing to a slightly more sophisticated discourse on what the future of the U.S.-China economic relationship looks like. The conversation around decoupling is largely seen as a pretty infeasible task, and now there is increased conversation about how do you, quote-unquote, de-risk, how do you kind of carve out the areas that you're most concerned about. And by the way, this applies on the China side as well. They've certainly been concerned about over-reliance on U.S. technology for some time now, even before the latest U.S. moves to restrict their access to it. So I think that's going to be part of the conversation going forward is how do we maintain an economic relationship that benefits both sides while still preserving each side's perceptions of their national interest.
How do you view some of the, I guess, it's maybe unfair to call it unrest or anything like that, but the dissatisfaction among the population with, well, boy, we put our money into these apartments, or we're not seeing the return, we're not seeing payments on our investments. I think there's to some degree, at least a certain segment of the population feels a little perhaps betrayed by what's happened with respect to some of the economic situation that's been going on. How do you view the population and their reaction?
I think that's a really important question. I think it's especially important for youth, right? Many of whom are emerging from college and looking to land their first job, looking to find, their first home to live in, start to kind of acquire assets. That's a really important part of sort of the cycle of life there, having property in your name as you start to build out your own life for yourself. And I think people are starting to feel sort of a major difference between the situation of growing up in the 90s and the early 2000s and 2010s as China was on the ascent and livelihoods were significantly improved from prior generations into perhaps what is going to be a new mode of, as Beijing would put it, high quality growth rather than necessarily focusing on the top-up GDP numbers.
It's for a while there, again, as you mentioned, back in those time periods, it seemed like China was opening up and that was a good thing for the world. Is it now simply the fact that Xi continues to be even more firmly enhanced, that doesn't necessarily need to do that anymore, and he can kind of go back to maybe what his natural inclination was, which would be a little bit more closed?
I think Xi's dual circulation policy is a really interesting example of kind of the twin paradigms that they're trying to hit here, of one, not necessarily being overly reliant on foreign technology for fear that access to that could be cut off, right, as they see recent U.S. moves as kind of indicative of that perception being valid, while at the same time recognizing that in order to continue growing, in order to kind of beat the middle income trap, China needs to continue advancing technologically. And right now, a lot of that sort of superior IP and technology exists in other economies that they need to learn from. So I think that's the thrust of his approach, is trying to balance and make that bridge without becoming overly reliant on what he sees as being a risky sort of proposition.
All right, Jennifer, thanks so much for joining us. Geoeconomist, I like the term.
I love the term.
And I like Jennifer Welch. You're going to be coming back here. You got new friends at Bloomberg Radio. Jennifer Welch, Chief Geoeconomist for Bloomberg Economics down in Washington, D.C., trying to kind of get a sense of what, geopolitics, economics, they certainly have, they certainly influence one another, and that's kind of what I think Jennifer Welch and Bloomberg
So many
Economics.
interesting data points and headlines recently. The latest one, China, please visit shadow bank investors at home to quash unrest.
There you go. We're going to have more coming up. This is Bloomberg.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg Radio, the TuneIn app, Bloomberg.com, and the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
A lot of economists are still talking about a recession. I am not buying it. I took it off the table a month and a half ago. I'm just not buying it. But I like to talk to people who are actually out there in the marketplace, talking to companies large and small, giving a sense of kind of what they're seeing out there. And we've got a great opportunity now. Don McCree joins us. He's head of commercial banking and vice chairman at Citizens Financial, publicly traded bank. CFG is the ticker. About $13.3 billion in market cap. Looks like it's been caught up in some of that regional banks downdraft there, off 28% year to date on this stock. Don, thanks so much for joining us here. What are you seeing out there? I mean, I think about Citizens. You guys talked to pretty much everybody, small businesses, mid-sized, larger companies. You compete against the big banks. What are you seeing out there from your clients?
It feels pretty good. We're not seeing a lot of distress in the portfolio. I think companies are generally performing pretty well. I've said before that, because of COVID a couple of years ago, companies really tightened their belts. They got their cost bases down. They built their liquidity. They refinanced their debt. And so they're operating with strong balance sheets. They've had some of the things that had been plaguing them, like supply chain issues and things like that, seem to be behind. And a lot of the input costs that grew from inflation and the rapid changes of inflation have kind of subsided a little bit. So I think we're hearing pretty good things. There's absolutely a cautionary tone being flag being flown by a lot of the customers, just because there's still a lot of uncertainty out in the marketplace.
Right, and you wonder if companies have been preparing for a recession so long, if we don't see quite the depth of the recession that we could have seen, maybe they are just better able to prepare for it. I wonder though, credit is tighter. Do you see companies delaying transactions, deals?
It's been the demand for loans is definitely tepid. And I think a little bit of that, particularly new money transactions. And I think there's a little bit of a hesitancy to invest right now. There's definitely a little bit of a weakness in the leveraged buyout markets and some of the big transactional markets. M&A is a little quieter than it's been. And a lot of that's because valuations need to adjust, and buyers and sellers are still quite far apart. We tend to play in our investment banking businesses in the middle market. That's been a little healthier because the transaction sizes are small and you don't have to raise massive amounts of capital to complete a transaction. And on the M&A side, it's a little friendlier from a government standpoint in terms of getting approvals for transactions. But I think regular way lending is okay, but it's not great. And I think that's more demand than supply, frankly.
Any stress in your loan portfolio at this point?
The commercial side's pretty good. C&I side, obviously real estate is the flashpoint, and office real estate is the place that we're all focused. We're working through the issues fine. We put a lot of disclosure out in the second quarter and kind of went through the portfolio. So, nothing that really is causing us to have sleepless nights, and we have an enormous amount of earnings power to basically absorb any losses that do come along.
Looking beyond yourself, there was a series of downgrades by Moody's on the regional banks. You guys saw your outlook cut, but that was actually a sort of positive thing. Right. looking at your peers, what's the extent of the commercial real estate stress that you see? That was a particular point that was called out.
I think, like us, I think most of them are working through it. It's going to be a 2 or 3 year kind of working through any distress we have in the portfolio. We're having a fair amount of success restructuring loans that we were worried about. So we've taken a couple losses, but nothing too significant. And I think as I looked at earnings from our peers across the board, everyone said about the same thing that we said, which is, yeah, we're focused on it. Obviously, there's going to be stress in the office market, but there's a lot of equity in these deals. That's the first to go, and then any losses that the banks will take are going to be, small fractions of the overall exposure.
Yeah, I mean, we've seen some of these large private equity firms or real estate firms in particular, like walking away from poor investments. I mean, to what extent are you guys happy to end up with the asset at the end of the day?
Well, we generally won't. We generally won't end up with the asset. We go to great lengths not to end up with the asset. So we would probably sell the note or do some other kind of restructuring and bring in alternative equity rather than take down the asset.
Let's talk just about some of the regulations on your industry. More coming down. What are you telling your shareholders about the regulations, how they're going to impact you, and kind of what you're trying to do to get ready?
I think there's clearly going to be higher capital requirements. There's going to be stricter liquidity requirements, and we're preparing for those. We have been preparing for those long before the regulatory kind of talk about exactly what it's going to be started to leak out. So I think that our returns will be a little bit under pressure, but the benefit that we have is we have a really diversified business model with a lot of earnings power. So if it goes down a little bit, we're going to continue to be able to return capital to shareholders, and it's going to be an adjustment. But we've been through these kind of adjustments before.
We had some reporting on how U.S. regulators are going to propose requiring banks with as little as $100 billion in assets to issue enough long-term debt to cover capital losses. And then the head of the FDIC coming out and talking about how this bolsters financial stability. Do you agree, disagree?
At the margin, it bolsters stability, but we think that the banks are in really good shape. We think capital levels are quite high, better than a lot of other parts of the world, and well-managed banks have really strong liquidity profiles and really strong capital absorption capacity.
How's loan growth across your client base here? Because, boy, we've been shocked with these rise in interest rates. If you want to go out and get a mortgage or if you want to go out and finance some capital spending or finance an acquisition, what's loan growth like these days?
It's been kind of flattish for the last couple of quarters, and we're expecting a little bit here and there depending on the sector, but we expect reasonably low levels of loan growth for the balance of the year. Less on the that's on my side. The retail side we're having some pretty good expansionary growth in places that we're growing on the retail side in the retail portfolio.
Well, have consumers just adjusted faster? Do businesses catch up with them to a higher rate environment?
Yeah. I think we have to keep in perspective that where rates aren't that high, and from a historical standpoint. Mm-hmm. So I think the issue with borrowers has been the speed of the change in rates as opposed to the absolute level of rates. So yes, I do think that consumers and businesses will adjust to a higher rate environment, and I think rates are going to stay high for quite a period of time.
University of Vermont, big fan. 2 of my siblings went there. You're a big player. Give us 20, 30 seconds on UVM.
UVM is doing fantastic. The school is growing. We're very financially healthy. Great statistics. The major thrust we have right now is growth of our research programs, and we're basically getting enormous levels of research grants from a variety of businesses and governments, and it feels very strong up there. And good. Burlington is obviously a fantastic place to go to school.
Man, my brother and sister went there. I'm like, why? And I had another brother go up there.
It's beautiful,
St. Michael's up in Vermont. Like, what are you guys thinking about? It's cold up there. So what do? I go south. Don McCree, head of commercial banking and a vice chairman, Citizens Financial, joining us live here in our Bloomberg Interactive Brokers studio. We appreciate getting some of his time. This is Bloomberg.
Thanks for listening to the Bloomberg Markets Podcast. You can subscribe and listen to interviews at Apple Podcasts or whatever podcast platform you prefer. I'm Matt Miller. I'm on Twitter at MattMiller1973.
And I'm Paul Sweeney. I'm on Twitter at PT Sweeney. Before the podcast, you can always catch us worldwide at Bloomberg Radio.